The saying, history repeats itself, is frequently used in technical analysis. Considering that even though it seems like the current global situation is unpredictable, it is likely that similar situations have occurred in the past. The current lethal mix of inflation hitting multi-decade highs, with the overall sentiment being heavily inclined towards the possibility of an upcoming recession, is the most spot-on sign of a stagflation. This scenario is strikingly similar to the one experienced worldwide in the 1970s. So let's take a brief trip back in time to understand the past in order to better understand the present situation and its future consequences.
World War II was one of the biggest and most debilitating wars in the history of humankind. After the war ended, it led up to a series of major economic and political crises, including the 1973 oil crisis. It happened after several Arab members in the OPEC, or Organization of Petroleum Exporting Countries, collaborated to increase the cost of oil to a whopping $12 for every barrel. This was followed by the prohibition of oil export to a bunch of powerful nations that included America and some key parts of Western Europe. Over time, the prohibition also extended to Japan.
This event is known as the OPEC oil embargo. The effect of this was witnessed by an explosion in the commodity markets that spilled over into all the others, leading to spiraling inflation and rising interest rates. Sounds familiar, right? This resultant hyperinflation in the States was countered with a catastrophic wage freeze that led to the parallel rise of unemployment and inflation in the country. In 1973, their interest rates shot up from 8.8% to 12% to almost 14%. Now let's see how the markets reacted during this period. The best way to predict the effect of global macro trends on the markets is to analyze the four main asset classes and their interrelationships. Bond markets prices are inversely related to bond yields. During that decade, bond yields increased as a result of interest rate increases, which in turn decreased their market value. The bond markets are considered as a leading indicator of the stock markets, and this is exactly what happened. The indexes corrected by nearly 50% in the entire decade. To compare it with the current situation, the rise of various commodities, including oil, due to wars and supply chain disruptions, added fuel to the existing inflationary pressures. Then came the rate hikes, and as the effect of the same was seen with an increase in bond yields, we are now experiencing a simultaneous crash in the bond markets and the major US indices. Now, what are we looking at ahead? There are three stages of a stagflation. First comes inflation, then once the markets have peaked, disinflation starts. In the period of disinflation or recession, the market finally starts correcting itself with a few bear market rallies in between. But a new peak will be out of the question. This stage is characterized mainly by new lows, panic selling, and the final bottom. Deflation is the ultimate stage where prices start to fall and inflation completely reverses, bringing the levels of both inflation and purchasing power parity to an equilibrium. We are currently at the cusp of inflation and recession, but the possibility of a deflation is highly dependent upon the fact that US doesn't print any more money to combat this situation. Well, as we can see in Europe, with the government handing out energy vouchers to help people sustain their energy costs, it does seem like we will be battling the current crisis in the same way as in 2008, by enlarging the bubble. While all of this holds true for the US market, contrary to popular opinion, India has not been following the American markets as of late. So what will be India's future path? As per D Street Chatter, it's believed that India is going to follow Japan's trajectory of the 1970s. That decade was known as the Japanese economic miracle because while the rest of the world was experiencing a 10x increase in oil prices, Japan adopted a strategy of low energy consumption by moving away from heavy manufacturing and towards a more service-oriented economy. Leading Japanese companies produced a compounded return of 20% annually during that time. Now talking about the current scenario, the balance of power in Asia is shifting in favor of India after the pandemic with the help of major technological leaps, geopolitical shifts, and most importantly, the global boycott of China. On top of that, various major changes like the rupee settlement system and the inclusion in the bond index are definitely working in our favor. That's all from our side. If you liked our content, don't forget to like, share, and subscribe to our channel to stay tuned with our upcoming videos.